Hello, everyone, and welcome into crushthestreet.com. I got another exciting interview for everyone today. I got Gino Barbaro on the line with us, and we're going to be having a conversation about real estate and really just, wealth building that financial freedom and how to do that. And we're going to go into Gino's story here. I said Jake. His website is jakeandgino.com. Gino, thanks for coming on the show with me today. I look forward to getting to know you and introducing what you have to my audience here today.
Kenneth, thanks for having me on. I appreciate it.
Well, you guys have a unique model for building wealth through multi-family real estate investing based on three fundamental proven principles. You obviously have a podcast, coaching products, a lot of real actionable ways to rubber meeting the road ways to invest in real estate. So I'd like to get started here. What are your thoughts on the real estate market in light of rising interest rates?
That is an excellent question. Unfortunately, I look at real estate as being not really only cyclical, but really to the market specific, right? So if you're looking at the coasts, cap rates are really compressed. Looking at other markets, they're a little bit higher. I'm fortunate that I'm in multifamily, that I think the long term for multifamily is great because you have millennials who are dwelling in their basements because they can't buy houses because they've got tons of student debt. The baby boomers are retiring, and why would they go out and buy another house? They're going to be renting. We have a significant amount of immigrants coming to this country still. They need to rent. So I think housing is not the dream that we thought it was. It's not an ATM machine anymore. So I think people's buying habits have been shifting to actually renting. So for us, that's great, right? Rising interest rates, I'm hoping that it'll slow down cap rates. I'm hoping that cap rates will rise a little bit and actually make these properties a little bit more profitable for us. For the last couple of years, rates have been really steady. It's been giving us a lot of lift on asset values. But our whole framework, like you mentioned, was buy right, manage right, and finance right. You still got to buy these assets right. You're making money on the buy. No matter what anybody tells you, you need to buy them properly. You need to get proper long-term financing. And then the third component is the manage right, is the wheel of the wheelbarrow. We talk about it. It's an on-day, ongoing operation.
So, Gino, you mentioned cap rates going up. That might have went over some of the audience's head, possibly. We got a smart audience here, but we don't always talk about real estate. The cap rate, talk about that a little more. Is it just rents rising that you expect cap rates to go up? What
Sure.
What are your thoughts here?
Well, the cap rate is basically a rate of return on real estate, irrespective of debt. It's just trying to get a rate of return, because once you start applying debt onto real estate, you're going to get different rates of return. So cap rate is one of those things that's, hey, listen, this is flat. There's no debt on it. Where would you get? The average cap rate in the United States, I think right now, is around a 6% cap rate. Looking at it traditionally in a slower economy would be 8, 9 caps. In these hot markets, let's take, for instance, New York City, San Francisco, cap rates are really lower. They're 3 and 4. Now, why is that? It's the perceived value notion that, the less risk in a market, the less return people are willing to get, and the higher risk, the higher rate of return. So if you go into a market that's in a depressed area, that has crime, it's in an older building, let's say, which we would say would be a C or a D area, you're going to get a higher cap rate. So higher cap rate means a lower price. That's what they're inverse relationships, right? So as the economy slows down and as interest rates come up, cap rates are going to start increasing, because they've been going down for the last 3, 4, 5 years. They've just been decreasing. As everything slows down, cap rates are starting to rise right now because of the interest rate, volatility going up, and as values slow down. Now, one thing that's been helping cap rates and the real estate market in general is rent growth has been amazing for the last 5 to 6 years. We experienced a 5% rent growth in Knoxville last year. And that's really hefty. If you're thinking about how much we've gotten over the last 5 or 6 years, it's been 40% over the last 5 years, and we've gotten an additional 5%. And that lets me know that our market is still healthy. We still have rents that are $240 a month less renting than mortgage. So mortgages, people who own houses are still paying $240 a month more when they're buying their homes and mortgaging out that as if they want to rent. So we still have the ability to raise rents there. So, rents, that ability to raise rents is key in our market, because in our industry, because as you raise rents, you're raising the net operating income of that property, and you're raising the value of the property.
Absolutely.
That makes sense?
Well, that's the beautiful thing about commercial properties is that it really does come down to the numbers. It's not so
Hmm.
much just a house where, people pay whatever price to live in a certain area, but when
Hmm.
it comes to a multifamily unit, it really does come to how much you want to spend on it and what your return is going to be. So,
Hmm.
if you would maybe take us through a hypothetical purchase, if we're kind of trying to go through this. We're getting to know each other here, Gino. But by way of example, how would you go about purchasing a multi-family unit? What would you look for, and how would you help us understand this process a little bit better?
Well, let's rewind a little bit. First of all, before anybody puts any money into any type of investment, they've got to know why they're doing something. Why are you putting money into the stock market? Why are you putting money into bonds? Or why are you putting money into gold or real estate? Figure out for yourself what you're trying to achieve. Why are you buying whole life? All these things have all different reasons and all different strategies. For us, real estate, for me, when I was working at the restaurant, I had a restaurant for 20 years. I would have fixed and flipped, but I didn't want another job. So I said to myself, what can I do part-time, make some cash flow on the side, pay some bills. I've got 6 kids, raising a really big family. So I need to do something to put money in my pocket while I have a full-time job. And hopefully I can transition out of my restaurant and get into apartment investing. So that was the epiphany for me and Jake. We said, we don't want to buy one house here, one house there, one house there. And we're working full time. We can't manage these things. So our first purchase was a 25-unit property back in February of 2013. It was purchased for $600,000. We had 10% owner financing. The owner held a note for 10%. We came up with 10% as a down payment. We got bank financing for it. Total closing costs out of pocket for us was $83,000. So we bought this property, 100% control with only 10% down. The sellers held a note. The great thing about this was it was 25 units all in one property. We were able to manage it. Jake was working as a pharmaceutical rep at the time. So he was able to manage the property. He was working full time and doing this. And for us, it was great. We loved real estate. It gave us the cash flow we wanted. It gave us the control, as you alluded to. Listen, you want to raise rents? You want to kick somebody out of your thing? You want to get a resident manager? You have the control over that asset. And I think the thing that most people make mistake on when they look at real estate, whether it's single family homes or multifamily, it's really a business. You're running a business, and it's about the numbers, as you alluded to. It's not about the color of the wall where you are, or your couch, or the view. It really is about the numbers. So that's what really drew us to multifamily.
So you alluded to how you got started, but maybe you could just give us a little more of that introduction,
Sure.
how you got started, how you do what you do, and how you're grooving today.
Sure. So, we started buying by ourselves. We didn't syndicate. We have over 900 units right now, about $60 million in asset value. We have not syndicated a deal. It's all been our own money, me, Jake, and another partner. We've been able to buy these properties. We've been able to refinance them, push the values up, refinance them, and repurpose the money into the next one. It's given us control, but at the same time, guys who syndicate and raise money for deals, they grow at a much faster rate. They have investors. We never wanted investors. We're actually syndicating a deal now. We just never wanted to get investors. We just thought, hey, let's think small, let's control it ourselves. But now we've thrown our hat in the syndication pool, and it's a really unique strategy. It's a really unique thing that we love it. But to get back to our first deal, we bought our first deal in February of 2013. We had the strategy. We wanted to raise rents. We wanted to lower expenses. And that's what we ended up doing. We ended up raising the rents, lowering expenses. 18 months after that property was purchased, we were able to refinance it and pull out $164,000 out of that property. So we put $83,000 into it. We pulled out $164,000. We added debt onto the property, obviously, but with the increased income and decreased expenses, our mortgage stayed exactly the same. The terms we got in our first purchase were terrible because we were newbies. We didn't know what we were doing. On the second go around, when we refinanced it, we got a better yield, a better term. We got a better interest rate. We got a better amortization schedule. So it was awesome. And to this day, we still own the property, and it's generating between $2,000 and $3,000 a month of free cash flow. It's an awesome deal. 4 months after that first one, we bought our second one, which was 36 units. So we scaled up pretty quickly. 6 months after that, we bought our third deal, which was 136 units. And from there, you get the credibility. You start buying these assets. You start able to build a team. We were able to hire full-time maintenance staff, full-time property managers, and it allowed Jake to go work, in the business. not only just in it, but on the business also, as far as hiring, team and, building it out. And we have almost 30 employees now, 5 years later. So we property manage, we're vertically integrated. We take care of all aspects of the business, the purchase of it, the property management of it. We've got an education company. So we've pretty much, controlling the asset.
That's amazing, and congratulations on your
Thank you.
Success and it happening so fast. I mean, what an amazing thing, and you really have exemplified the power of leverage. And maybe you can expand on that a little more, because that's a really powerful thing that you've been able to do, is kind of get moving on your first one, and then continue to do that. And it really goes to show like how sometimes it's hard to get started. It's hard to go from 0 to 10, and it's much easier to go from 10 to 50 once you kind of start to get the ball rolling. So maybe you can touch on that a little bit.
Sure. Well, Ken, I really want people to stress that whole why factor. I just did not like what I was doing. I hated my restaurant job, so I needed to do something else. So when Jake and I decided, he was living in New York, he moved down to Knoxville. When we decided to start looking for deals, it took us 18 months to find our first deal. I had been coached. I had the education. I knew how to underwrite the deal. I knew how to find the deal. I knew all the machinations of the deal. Jake was the one who was the boots on the ground, willing to do the day-by-day grind. Took us 18 months for that first deal, but like you said, it's all about momentum. Once you figure it out and it's proof of concept. I don't know what the Chinese proverb is. You see something, you forget it. You read something, you remember it. You do something, you understand it. And that's what happens with real estate. It's either you have 0 deals or you have multiple deals. There's nobody out there that's going to buy one deal and say, forget it. Because once you do your first deal, you're going to say to yourself, wasn't that bad? I didn't lose any fingers. I mean, I can figure this thing out. And that's what happened to us. We did our first deal. We got the bed bugs. We got, the lady who passed away in the apartment. We got the septic field failing on us. We figured it out. It wasn't as bad as everyone thinks it is. It's that fear that holds us back. But my why was so big that, dude, somebody passing away in the apartment is a learning experience. But I don't want that to stop me from, getting to my, my goals. And, we use it as a learning experience.
Powerful. I love it. So where do you guys focus on, and do you have any recommendations for hot real estate markets for people looking into multifamily units or even single families?
I would just be objective and be logical and take the emotions out of it. No matter what you think of this president, what he's done with the tax code is really huge, because what he's done is he's basically given the red states and the states who have more beneficial tax laws a bone. So everyone from New York, myself included, are moving. When you only write off the first 10 grand of your property taxes, that hurts. I mean, a lot of people are stuck in that fear mindset, but I left. I'm gone. I don't want to pay those property taxes. And a lot of guys are doing that. So people on the coasts, the blue states, the high tax states, they're moving to the Southeast. I mean, you look at Louisville, Kentucky, you look at Atlanta, you look at South Carolina, North Carolina, that's where the concentration is. So whenever you're looking for a real estate market, guys, just look at the job growth. Look where the jobs are going, because that's the most important thing. Because, I'll mention it this way. There's something called the white collar multiplier effect. When you create one white collar job, you're going to create 3 to 4 blue collar jobs, because you're going to need dry cleaner, you need a pizzeria guy like I was, you need a gas station. So that multiplier is huge. So when you're seeing all these areas with these jobs that are burgeoning, when you see the Amazons opening in the world, that's where you want to focus on, all those cities. I can go on. There's a lot of cities in Alabama that are burgeoning. Texas, Tennessee has been a great market. Texas is a little overbought because everyone's moving to Texas. I mean, San Antonio had 23,000 people move there last year. So some markets are a little bit overbought, but they will be there. Same thing with Nashville, Tennessee. It is an amazing city. I think net 40 people a day are moving there. So you've got to be careful as far as what valuations are, but just focus on those cities where people are moving to.
Yeah, powerful. You sound like you were describing me there when you're talking about people moving from blue states to red states.
Did you make the jump?
I did. I got out of California, and I live in Texas now. So
do you really? When did you do that?
Well, you talk about the taxes. They don't like to treat capital very well in California. So
when did you move? How long did you move?
Money flows where it gets treated best. So California could shove it in that sense.
It's funny, Ken. It wasn't so beautiful and so amazing to live there in San Diego, all they wouldn't have to, they could be sloppy. They're sloppy because they can do that. So you look at a state like Oklahoma. Who's going to move to Oklahoma City? It's a pretty burgeoning thing because it's business friendly. They need to attract capital, so they need to give people incentives to move. And the same with Dallas, Texas. I mean, you can't compare Texas to California. I mean, for the most part, California is amazing. But when you're paying 53% out the door and you're paying 13% state income tax, the average person doesn't want to pay that. I was had a conversation with my 10-year-old yesterday in the car about property taxes. And I'm telling her what we paid in New York. First of all, she doesn't understand property taxes. We have 6 kids at homeschool them. So she's like, you're paying to go for school? I'm like, yeah. She's like, how much, Dad? I said, $27,000 a year. And she just could not. It's great when you see a child who's bewildered. That's how we as adults should be. Like, we're paying that much for school, and as adults we just become complacent and go, as my mom would say, hey, that's just how it is. That is not the way you should go through in life. It's not how it is. That's not how you did it, and that's not how I did it. We don't have to stick up for that. We have a voice. We have the ability to walk. We have the ability to live wherever we want to, and we can make excuses and say, hey, my whole family's there. I'm Italian like you. My whole family's in New York. It really stinks and it's really painful. But at the same time, for my children to be able to buy a house in the next 10 to 15 years, they can't buy a house up there. So I have to position themselves to become successful and to live in a place that's more affordable, and it's just a better quality of life.
Yeah, it's cheaper for me to vacation in California and live here, and I gladly do it now because the way I saw it, living there, I was going to be out the money either way. So if I want to be in California, I might as well spend that money in a way that I actually want to spend it. Like, I'll take my kids to Disneyland or, get a hotel on the beach and fully enjoy it rather than actually living in California and just giving that money to the government. So that's my rationale on that. So, but yeah, no, this is such a great conversation here. It really goes to show, and just talking about natural economics, and that's one of the things I really love. So talking about economics and the cyclical downturns, say we're on the cusp of another 2008 financial crisis, just say. How do you protect your assets? Like, how are you buying these multifamily or single families to, mitigate the risk of going into another mess? How do you control the damage in a situation like that?
Well, first thing you have to do is you have to buy right. So we look at hundreds of deals, and we've looked at, I don't know, over the last 6 months, 100 deals. We haven't closed on very many. So you have to be very, very selective. You have to stick to your criteria. You have to not fall in love with the deal, right? So the deal we're buying now is a mirror of what we bought 4 years ago. We know exactly what's going to happen with this. The other thing I think people need to do is, a lot of multifamily operators, they'll get bridge financing, mezzanine financing, where it's short term, there's no term, it's open, the rates are floating, and then when they refinance it, they will get fixed long-term rate. I don't want to get into that in the next 2 years because I don't know what's going to happen with rates. If Ray Dalio is right and we have the credit crunch in the next 24 months, I want to be able to have long-term financing in place. That's what I'm looking to do. That's what we're looking to do with all of our assets. Have at least 10-year term financing in place where rates aren't going to float. I think that's what people have to focus on. And I think their criteria for buying, they better be able to buy something with what we call a value-add component, where you're going to be able to either cut expenses or raise actually the income on the property to justify that purchase price that you're making. Does that make sense?
Absolutely. So in outside of Los Angeles right now, I mean, all over the country, the real estate market is pretty hot. You put a property out, it like sells in a couple days. But in certain markets, like where I live here in Texas, a little outside of Austin, it might take a little time for the property to sell. And that's kind of when these owner financing situations tend to be a little more helpful. It helps to like sweeten the deal a little bit. So in general, how much more can you sell a property for when you're willing to go the owner financing route, if any? Can you charge more at all?
That's a great question. I mean, we came up with the term mom and pop investors. So we love to deal with mom and pop landlords. Basically, a mom and pop is anyone who's running it, they're really burned out. They want to be retired. They just don't want the property anymore. They have no systems in place. On our first property, husband and wife, they were in their late 60s. They had health issues. They wanted to get out. So in real estate, I think everyone has to understand something. And I think this is general life. If there's no motivation to the seller side, you're not going to get a deal, especially in this kind of market. Just walk away. Don't even waste your time doing the underwriting, because if you're looking for a certain number and they're not going to come off of it and they have no problems for you to solve, whether they're an out-of-state owner, whether they want to downsize, whether they want to 1031 their money, whatever it is, if there's no motivation, you're not going to get a deal. So always look at that from that perspective. We focus on these mom and pops, and those are the ones who have the ability more to owner finance. So it's either price or it's the terms. So you may have to pay a little bit more. On the first deal we paid, we probably gave them an extra $25,000 or $30,000 on the purchase price. But what happens was you dictate the terms. We were able to get that owner financing, which is great for us. We come out of pocket with a lot less. And what was fortunate with us is we dealt with the bank. There's a bank that wanted to actually deal with this property because they had the note on this property originally. They knew what was going on with this property. They knew this property was a cash cow. So to them, no skin off their backs. I'm only going to put 10% down. The owner holds 10%, but you guys got 80% loan. So they were very comfortable with us taking that mortgage out.
Yeah, no, that's powerful. So, Gino, if you would share a little bit about what you guys do, and if the audience would like to reach out to you guys, what exactly do you offer, and how can they interact with you?
Sure, Kenneth. What we've done over the last couple of years, Jake and I have been able to create an education platform called Jake and Gino. From there, and we like to call it multifaceted. So anybody out there who's got a real estate business, who's got a pizzeria, who's got a plumbing business, think of your business has the ability to have multifaceted layers, multiple streams of income. So for us, I'll stick out my hand and just tell you what I'm talking about. For us, it was that investment property. From that investment properties, we started an education company that feeds it. We have a property management company. We have a syndication company. We're starting a brokerage company. All these different areas that are feeding off of this investment. So think big, start small, and as you start growing, you learn, you do, and you teach. So our education company has been able to sell education products, educate people on how to buy this stuff. And also, if they don't want to educate it, we're starting to raise money and just put our students onto our investor side. So that's what we've been doing for the last couple of years. I love it. My partner is day-to-day on the management side. I am day-to-day on the education side. Just being able to reach out to people. We have a live event in October 6th and 7th in Nashville. There's going to be about 400 people there. So we've grown a pretty great community or tribe. And multifamily is a niche business. A lot of people out there think they can't do it. It's all about getting with the community. It's all about getting with guys who do it. And it's about making those contacts, making those connections. Hey, who's the broker you use? Hey, what about your cost seg guy? Hey, what about your insurance guy? These are things that I think any healthy community can help you out with. And that's why we created the community.
That's a beautiful thing. Gino Barbaro, everyone, of jakeandgino.com. Gino, thanks for coming on Crush the Street with us today. I really appreciate your time.
Kenneth, I appreciate it too. I had a great time. Take care.